Hello class, this is Brian from FinancialTradingSchool.com and welcome to GT303 Diversification. So although the world doesn't think so, I like to think of diversification as a subset of hedging. Here's the difference between hedging and diversification. So hedging was the strategy that you use to reduce your losses within your trading position, while diversification is when you spread out your risk within your trading portfolio. People say it's not related to hedging because you put your money into unrelated instruments, but this indirectly reduces your overall trading losses. The way I see it is hedging is small scale while diversification is the big picture. And some common phrases that you might hear are diversification of your portfolio, or don't put all your eggs into one basket, and saving for a rainy day, which is more of a money management term, but it's kind of diversification at the same time. And as an aside, I may decide to do a mini series in the future for managing your money or personal finance, but this lesson will suffice for now. Although diversification is the mainstream word, the terms that I prefer using are resource allocation and risk spreading, which I will explain at the end of the lesson. So there are usually three types of people, and depending on which type of person you are, you'll likely have different ways of managing your portfolio. So for a risk averse, this is a typical quality for an investor, and risk aversion means you don't like risk. You prefer safety over growth. And as you'll recall, the topic of capital preservation from GT303 Money Management, people prefer safety over losing their net worth, specifically the people who have more to lose, because when you have more, you care more about losing. And then there are risk-neutral people, and risk-neutral means you're indifferent, which means you don't care, between safety and growth. That means if given either choices, you'll be happy with them. Then you have the last one, which is risk-loving, and this is a typical quality of a trader. Risk-loving means if given the choice, you'd prefer risky assets with growth over stable assets that are just stable, and you don't lose any money investing in them. But when you dive in and examine each of these three types, essentially all it is your portfolio is broken down into two main categories. Short-term / volatile assets, which is the trader mindset, and you have long-term and stable assets, which is an investor mindset. And regardless of what type of person you are, you should have both types of positions in your trading portfolio. How much money you put into each type depends on your type of person. If you're in a risk averse, since you prefer stability and safety, you'd put more money into long-term assets over short-term assets. For example, you might devote 75% to stable assets while you put the remaining 25% into volatile assets. If you're risk neutral, since you're indifferent, you pick whichever one that you understand most. So if you understand stocks instead of Forex or something, Forex is more volatile while stocks are more stable, so you might split accordingly. Or you might do 50-50, but it depends on what you understand more, because that's what you're going to be more comfortable with, which is why you put more money into that one. Then lastly, for risk lovers, since you prefer volatility and risk, you put more money into short-term assets over long-term. For example, you'd put the opposite of risk averse, so you put 75% into volatile assets, while the remaining 25% goes into stable assets. But something for all three types of people that you should consider is resource reallocation. Regardless of how your portfolio is split up, focus your attention on the short term, since that's what happens immediately in the immediate future, and then you move all your profits into longer term assets, because those can wait while you focus your attention on short term assets. And the primary reason why people want to diversify is because each trading instrument has its limits, because after some point it's no longer realistic to scale it. Although people often say money is scalable, it depends on the instrument that you're trading. So for example, penny stock companies are typically worth under $50 million. So billionaires can't really invest their entire portfolio into this, unlike blue chip stocks, which are worth hundreds of billions of dollars. So you can easily scale up your portfolio if you need to. Also, short-term assets are volatile / risky. Even if you're a risk lover, why would you leave your money in a risky environment for long periods of time? And this is what I was saying with resource reallocation. You focus them on the short run, then you move them later on to the long-term assets. And as you recall, short is associated with risk, while long is associated with stability. Everybody, regardless of what type you are, starts off as a risk lover due to greed, because everybody wants to get rich overnight, everybody wants to get rich fast, everybody wants to be a millionaire, etc., etc. But once you accumulate some money, you don't like risk anymore. Remember capital preservation? Once you have more, you tend to care more about what you have to lose. So eventually, people just change their portfolio diversification over time to match a risk-averse individual. Lastly, before we end off the lesson, I just want to ask a question of what if. If you recall from the first slide, hedging relates to your trading position, while diversification relates to your portfolio. What about diversification within your position? Have you thought about that? This is a what if question for you. So I was originally planning to include this with the previous video, GT302 hedging, but I decided to put it here instead. And this is called resource allocation / risk spreading, which is why I like to use these terms. Just like your portfolio, why would you put all your eggs into one basket? Why would you go in for your position at one price? Why bother? Something to think about, okay? If you were going to put 20% into a stock position, why not split that 20% into different entry points? Sure, 20% is a max you're willing to risk, but you don't have to go all in at once. What if it's a bad price later on? You're going to have hindsight, etc. So you spread your risk. So you can split it into 4 separate 5% trades at different price points. And again, just like money management and hedging, I'm not going to detailed number examples here. That will be saved for the individual trading series. And when I do them, I'm going to have a separate video on money management, but this diversification topic will be included in the hedging method. Unlike here, it's separated in the general theory part, but in the trading series, it'll be combined because there's no point. It's the risk spreading, there's not much to talk about because essentially I just told it to you. You split your trade into multiple trades. So if you take a 10% trade, you can split it into 10 individual 1% trades, or 5 2% trades, or 4 2.5% trades, etc. I think you get the message. So anyways, that's it for this lesson. Hope you guys enjoyed it, and I will see you guys next time.